Okay, so welcome everybody to this Payments Journal webinar where we're going to be talking about transforming your payments data from a cost center to a profit center with our guests, ARM Insights and Mercator Advisor Group. Now, a couple things before we get started, just a few housekeeping items. This webinar will be recorded and the webinar will be available after this is concluded. And there's also going to be a Q&A section at the end of this webinar as well too. So without any further delay, our guest speakers for today, we have Randy Cook, who is a successful technology and data executive with experience in a leading startup and multinational companies. As CEO, Randy has led ARM's growth to successfully monetize data for over 1,000 financial institutions by leveraging ARM's innovative synthetic data platform. Randy is widely considered a data thought leader, authoring the Data Monetization Roadmap, which is the standard methodology for securing monetizing data. And we also have Tim Sloan, who is the VP of Payments Innovation and the Director of the Emerging Technology Advisory Service that focuses on business impacts of these new technologies and their potential for issuers, merchants, card networks, acquirers, and vendors competing in this tech-driven landscape. So without any further delay, Tim and Randy, you have the floor.
Oh, thank you, Ryan. This is Tim. I should probably start this all off by saying about 2 years ago, I wrote a Machine Learning 101, where I described the use of machine learning to create synthetic data. At the time, I was unfamiliar with anybody who had actually executed it. So it was kismet that I bumped into ARM Insights and saw an actual implementation that was driving those machine learning tools to create synthetic data so that it could be shared safely with others. And so the primary question we're going to answer today, what if you could monetize your data without worrying about privacy, regulatory, or security concerns? Obviously, risk and compliance organizations are paid to worry specifically about these issues. But Mercator believes that a properly implemented and managed data sharing platform can actually eliminate, yes, I did say eliminate, all of these concerns. Doing this in a fashion that eliminates these risks also somewhat limit the use cases to which your data can be applied. However, it delivers a starting point from which, with careful planning and management, can be expanded to embrace consistently larger and new use cases that can drive additional revenue, many of which we're going to describe briefly today. But first, I think it's important to think about what's the potential in data monetization. So clearly, monetizing data isn't new, although participation in the market by financial institution is perhaps a more recent event and has resulted in occasional bad press events when done improperly or without explanation. Doing this right is critical, and we'll share thoughts on that today. But the expectation is that the market associated with data monetization is going to be approximately $400 billion by 2023. And this market isn't limited to financial institutions. Interest in data contained specifically within payments transactions is high, and payment networks and banks have started to monetize those transactions. But that's really the tip of the iceberg. Let's take a look at the larger market. So this is a wheel that Mercator and ARM Insights created specifically for this webinar. It breaks down the data monetization opportunities across internal and external components. Internal can sometimes be difficult due to internal silos that have been established across data warehouses and databases. And so pulling that data together can prove difficult even within a single organization. But the data can be used internally to provide insights and help with self-service, validate key life indicators, provide insights into attrition and how to retain accounts, and perhaps even compare customer insights against external non-customer markets in order to better understand if your customers are behaving the way others do and what you might need to do to shape a solution that can broaden your market opportunity. But clearly, institutions are moving beyond cost savings and internal sales and are considering how revenue can be generated from data itself with external implementations. And these might include data used to help companies identify locations for new stores, investment firms looking for trends within transactions, or competitive analysis on what shoppers are buying, all of which can be done anonymously and be done safely. And so with that general structure understood, let's move over to Randy to share his insights into how data monetization can be safely accomplished.
Great, thanks, Tim. Again, my name is Randy Cook. I'm the CEO of ARM Insight, and I'm going to spend the next 10 or 15 minutes explaining the structure and some real use cases around how to safely monetize data. But let me first give you a 1-minute overview of ARM so you have a context of how these use cases apply. ARM Insight, as mentioned at the beginning, is a data company that safely monetizes data for 1,000+ institutions, including 5 of the top 20 banks and 2 of the top 10 fintechs. And I look forward to sharing some real use cases that we've seen from the industry over the years. Before we jump into this, there are 3 key themes that I want you to take away from today's webinar as it relates to turning your data into a profit center. The first is that the financial industry has the most valuable data across all the different verticals, but is scared to properly monetize it. The only other industry that is comparable is the healthcare industry, and that's a close second. But the point is here, the people on this webinar sit on very valuable data, and we must understand it better so we can properly monetize it. The second takeaway is you can absolutely safely monetize your data with the blessing of your compliance, legal, and security teams. I know that sounds a little bit crazy right now, but that is absolutely the case, and we'll show you how that's done here shortly. And the third takeaway I have is better understanding your data. As Tim mentioned, synthetic data has been emerging over the last 18 months, and it is now fully in production as a new data type, and it is the way to safely monetize your data, and you should be considering it and using it now.
Yeah, it's a breakthrough.
So let's now talk about financial data. It's important to know that financial data is not one big bowl of scary, personal, sensitive data. Rather, what it is and should be broken into is 3 very different and distinct data types that each contain a different risk profile. So we're going to spend some time on this slide because this is one of the signature slides of today's webinar. So the 3 different data types are raw data, right? And raw data is exactly what you would think it is. It's this first row here, and it contains all the personal information and all the exact raw information of the transaction itself. And as you can imagine, and I'm sure you're aware of, that the risk profile of raw data is very high. You should treat it carefully. If you do monetize this, you better be very careful, and it has to contain a high-touch review with your security, compliance, and regulatory teams. That's raw data. Anonymous data, the second type, is simply removing the personal information while keeping the transaction information the exact same. So for anonymous, the risk profile comes down dramatically, and there are various use cases on how to monetize anonymous data that we'll go over later. The last one is synthetic data. Synthetic data is the new emerging data type that maximizes the value of your data while minimizing and eliminating your risk. Synthetic data, so the way this is structured, what synthetic data does is it creates an entirely fake data set while retaining the exact statistical value of the original data set. You can see here in the slide that each individual field is slightly altered but that the aggregate value of the data set will remain the same over thousands and millions of transactions. And just a good example here, you can see how the transaction date is slightly altered, and you can see that the transaction amount is slightly altered as well. But on an aggregate basis, it will retain the exact value of the original data set. And the reason why synthetic data is so important and is the safest data type and best way to monetize your data is it has three specific benefits to it. The first is consumer privacy. Synthetic data can never be traced back to the original consumer. The second benefit is regulatory and compliance. Because synthetic data is a fake data set, it lies entirely outside of GLBA, PCI, CCPA, etc. And lastly is availability. Because of the two prior benefits, you can now make synthetic data widely available to both your internal organization and your external channels. So let's go ahead and move the slides and see how this works in real practice inside real financial institutions and fintech companies. Great. So here's how it works inside of a financial institution. So the first and most important thing to note is that the synthetic data app in the lower right-hand corner is installed inside the financial institution's firewall. And the key thing about that is, therefore, only synthetic or fake data ever leaves your firewalls. Let me repeat that. No real data ever leaves your firewalls. And that leads into the use cases that Tim started to talk about, and we'll go into more detail shortly. The first is internal innovation and building products and monetization products internally. So that's where you simply build use cases like consumer analytics or AI ML inside your firewall for your use cases internally. And we'll give more examples here shortly. For external, this is where you send the synthetic data to two different groups. One is strategic partners. So you may have strategic partners that you want to share your data with that can help you with things like better fraud identification and better loyalty participation. In the past, banks have been hesitant to send data outside their firewall and engage with other fraud entities because they're afraid to send raw data outside their firewall, and they should be afraid to do so. But sending synthetic data to other data partners that you trust is a great way to go, and it makes your ecosystem larger on who you work with and share your synthetic data. The second major case for external data monetization is simply sending that data to new customers. So we'll show you here shortly, but there are many entities outside of financial institution, including retailers and investors, that would love to buy and see synthetic data, creating new revenue streams for the financial institution. Again, the key part here is that only synthetic data leaves your firewall.
Yeah, it's fantastic, the ability to create that synthetic data, maintain on aggregate a statistical representation of the data, while all the data elements have been modified or stripped out. Makes it an extremely safe way to be able to share that data.
That's exactly right. So on the next slide, we'll talk about the various internal data monetization use cases. Can someone please go ahead and move the next slide? Okay, here we go. So here are 5 common use cases where the financial institution can monetize their data internally, and we'll cover 3 of these here. The first is data governance and data security, which I'm sure is of utmost importance to the people on this call. And the second one is all about top of wallet spending for institutions that have credit cards, debit cards, etc. So let's go into a couple of these. So the first one is on the data management and data security. So recently, about 3 months ago, a top 10 bank approached me with the following use case. The exec said, Randy, I have more than 100 different developers that are building products off our raw data. And our single biggest data threat is employee abuse or employee misuse of the actual data, which, by the way, is probably the biggest data risk for most people on this webinar. The fact is, in reality, and this is the actual use case we talked about, she said, only 10 of my employees out of the 100 really need access to the raw data. And what she said is, can I have the other employees build products on top of the anonymized or synthetic data? And the answer is absolutely yes. So let's see how this works. So instead of 100 developers looking at the raw data, which obviously contains a high risk profile, what we did instead is we created synthetic data, as you saw on the prior slide, and then we made that synthetic data available to the other 90 employees, such that the end result was that only 10 of the engineers and employees and quality assurance employees needed to be looking at the raw data, and the other 90 employees could work off the synthetic data. And this has two major benefits back to the banking institution. One is they drastically reduced their security and data threat by minimizing the number of people that need to look at raw data. And the second is they made available, broadly available, synthetic data so that the rest of the organization could build internal products, whether it's analytics, machine learning, etc. Let's now look at another example. Tim, did you want to add something there?
I just wanted to say that's a great example. You know, the insider criminal is one of the toughest to defend against. You never know who it is. So finding a way to be able to get the synthetic data into the hands of those developers is a really great use case.
Yeah, no, totally agree. And the next slide here is another example of internal data monetization. So one of the most frequent questions we get at ARM Insight is, how do I get, and this is for institutions that have credit cards or debit cards, how do I get our cardholder more top of wallet? So the average person has 4 to 5 credit or debit cards, and obviously what any banking institution wants is to have their card spending the most transactions. More transactions obviously equals more revenue. So what we did here is we ran some analytics on synthetic data to find out what drove top of wallet spending. And the first part of our analytics actually was not that surprising. So if you look at the middle 4 categories, gas, restaurant, Amazon, and bill pay, most seasoned execs or regular analytics would have identified that those 4 categories drive top of wallet spending. However, after we ran the machine learning algorithm on top of the synthetic data, what emerged was 2 other categories that drove top of wallet spending. The first is drugstore spending. So in other words, when someone put their card down either online or was spending at a drugstore, they were 10 times more likely to be top of wallet spending by simply spending at drugstores. Again, this was a category that wasn't identified by analytics and not readily available or not readily known by most execs in the space at the time. The other category that we found to be very interesting was a category that we have called FLUIP, which is actually a really bad category and a really bad acronym. It's actually a great category. It's a terrible acronym created by a data scientist, but the findings were great. And here's what it stood for. So what we found is if a given cardholder, and I'm talking about, we looked over billions of transactions, and I think it was 50 million cardholders or more. If a given cardholder spent at food delivery, so that's the F, food delivery, think obviously Uber Eats, Postmates, etc., or Uber, or Lyft, or iTunes, or PayPal, they would be 9 times more likely to be top of wallet. So the takeaway there is a couple things. First of all, the institution then, you're much more incentivized to create campaigns or promotions around these categories, drugstore and the 5 fully merchant categories. Secondarily, and that will obviously drive a lot more revenue. Secondarily, now that synthetic data is made more available for your teams to use machine learning and AI, you can apply many more use cases of machine learning to internally to drive more revenue to your organization. Next slide.
Great.
Okay, so now we're going to move into external data monetization. And as Tim and I said at the onset, just think of this as 2 broad categories: sending synthetic data outside of your firewall, and you can feel safe, again, to reiterate, you should feel completely safe in sending synthetic data to 2 different entities, to strategic partners and or to customers that will pay you for aggregate synthetic data. And over the years, we've seen 3 categories of buyers that love to monetize synthetic anonymous data, and that's retail brands, commercial real estate, and investment firms. And I'll give you some use cases of each of these.
Hey, Randy.
Yeah.
Could you describe how many of these use cases are looking for information from a single institution versus perhaps aggregate from multiple institutions, maybe to cover a geography?
Yeah, no, that's great. Let's see. It varies by use case, but in general, these 3 categories want the most broad coverage you can have. So the way I would say that is a top 40 or 50 banking institution probably has the right coverage, assuming they have the right geographic coverage, to go ahead and just have one institution monetize this. However, if you are smaller, anywhere from institution number 50 to say there's 12,000 U.S. banks, then you would probably need someone to aggregate multiple banks, and that's of course something that ARM does. So again, if you're a large institution, you can probably do this yourself. You'd have to create the synthetic data. If you're a smaller institution, you would probably need to aggregate it through some other aggregator, because at the end of the day, what these buyers of aggregate and synthetic data want to know is that you have to have enough statistical relevance and enough geographic coverage so that it's statistically relevant. Tim, does that make sense?
Yeah, and it's another service that you provide, or they could go to another aggregator and utilize your synthetic data to make it safe to provide to that other aggregator.
That's exactly right. I think the takeaway for everyone is once you understand the different data types, it's important to create synthetic data. Then you have safe options to monetize your data.
All right. Thanks.
Okay. So let's see, this first one is a retail example. And we did a study for essentially the coffee sector, and specifically in this case was Starbucks. And in this case, what Starbucks wanted to know was, how am I doing versus my competitors in a specific geographic location? And this happened to be in Chicago across various zip codes. And more importantly, they knew how they were doing internally. Of course, they have internal data. They had no idea how they're doing versus their competitors. And the biggest takeaway, as you can see here, is that McDonald's was obviously winning in most zip codes. However, there were 2 zip codes at the very end where Starbucks was the winner. We normalized this based upon number of stores and foot traffic. So it's not just the case that there were more McDonald's, but what you'll see here is that in the last two zip codes, 60657 and 60614, Starbucks absolutely dominated. That's probably too strong. They were at least winning against Dunkin' Donuts and McDonald's, and therefore wanted to do a deeper analysis into what they were doing differently in those zip codes versus the others. And by the way, this is all normalized across income and number of visits, et cetera. Furthermore, we could also take this down to a demographic study. So if you want to know broadly how millennials are spending versus boomers versus Gen X, you can still do that same aggregate information here. So the takeaway of this slide, again, is that synthetic data allows the banking industry, the financial services sector, to safely monetize your data. And these retail institutions want to buy your data, and they don't really care about personal information. They don't want to know exact consumer spend. They want aggregate information that tells them how to make more money. So that's one example. Let's look at another example. This example is what I'll consider pretty basic competitive insight analysis that we did for Nike. And they wanted to figure out, and this was online only, of course, you can do online or offline, but this was, how was Nike doing versus Adidas and Under Armour? And again, this was looking at aggregate synthetic data across the U.S. The first part of this is not a big surprise, which is Nike's average transaction, that's the y-axis, is more than Adidas and Under Armour, and that's simply because Nike sells more shoes. There were, however, two big takeaways that Nike took from this. And again, before I give you the takeaways, keep in mind Nike had the same comment that other institutions would have, which is, Randy, we have all of the data about our own organization. The competitive analysis is stuff that's hard for us to get to. So the two other big takeaways was, one, Adidas is growing at a pretty good rate, whereas Nike and Under Armour were flatlining. And the second big takeaway is if you see the spikes in Adidas spending, the big takeaway there was a lot of times in the retail sector, and specifically across these three, they share in similar spikes and promotions. Like you can see here, February of 16, both Adidas and Nike shared a spike of promotions in February. But what was really interesting in this case, Nike, was why is Adidas doing better than us in promotions and campaigns? And obviously, ARM doesn't know the answer to that. That's analysis they have to figure out. But the fact of just knowing this aggregate data on their competitive analysis is something that retailers are happy to spend money on and want to get safe information from the financial sector in order to do these types of analysis.
These are great examples of the way retailers utilize the data and can utilize the data that you're able to provide through synthetic data. Are retailers one of your primary buyers of data, Randy?
Yes, and in general, not only for ARM, retailers are a big buyer, and typically they'll buy through other channels as well. But yeah, that's it's a huge appetite for financial data. You know, as I said earlier, the other two would be real estate. Investors want to know about that. So think about if you're a real estate strip mall owner and you're going to buy or sell an existing property, you want to know how the given Kroger's doing, or the given Safeway, or the given Starbucks is in that strip mall. And again, financial data is a leading indicator for how those given entities are doing inside that strip mall. So real estate's another large buyer, and the other one is investors. So think of mutual funds or pension funds that want to have a good understanding of, you know, how a given public company is doing same store sales. Those are the three main entities. And there's also other examples in ad tech. However, ad tech tends to lend towards more, they want to know personal information, so we stay away from that because we believe synthetic data is the first step for the financial services organizations to approach the market. So those are the three main categories.
Yeah, ad attribution can be a problem.
That's right, because there obviously you have to follow the actual person, and that requires a whole different set of rights and compliance that is just way outside of the typical synthetic or anonymous data that we think people should start monetizing.
There's one of the ones that can get you in trouble.
They can, that's right. So before I close here on the roadmap to safe data monetization, I wanted to go back to the way I started this, which is there are three main takeaways I wanted this webinar to have for financial services. One is you sit on very valuable data, and you shouldn't be scared to start your path of monetizing that data. There are safe ways to do it if you can break it into those three categories. The second one is obviously you should start that data monetization, and once you're able to show security and compliance in your legal teams that synthetic data is a safe way to do this, you have a much easier path to monetizing your data. And lastly, synthetic data is the safest way to monetize your data. So I'm going to close here, and I won't go into details of our roadmap here. If we can just forward this slide a bit. But one of the major questions I get from talking to financial service organizations is, Randy or Arm, can you guys provide a little bit more detail on the methodology you use? So Arm produced a roadmap to safe data monetization that has 4 simple steps on how to monetize your data. It looks a little busy here, but I'd encourage you, it's on our website, it's free of charge. I'd encourage you to go to our website and actually download it. And it's something that takes what we decided here, what we discussed here, and drills down 2 or 3 more levels, such that even your legal or security or even your engineers can start to drill down and understand a little bit more around how best to safely monetize your data and turn your data into a profit center. So I'm going to stop there and open it up to questions.
Excellent. Well, thank you, Randy and Tim. Very informative webinar there. And if I could, I would actually like to take the first question. So, Randy, I think this one is for you here. So, what is the biggest issue your clients are trying to solve with synthetic data?
Yeah. So, in general, the biggest issues, it starts with the fact that financial service organizations are scared to monetize their data because they don't realize it's the 3 different data types. So that's number one. So so I guess I would call that education, just understanding that there are 3 different data types. The second big issue they tend to have is there tends to be a lot of different silos in a financial services organization. So they tend to have problems in getting their data into a common format or into one place so that you can create synthetic data. So it's what I'll call internally there's a problem of how they organize the data in the different silos and being able to go ahead and put that data into the 3 data types. And again, I encourage people to read the roadmap because there's actually a very simple way to do that without creating a 2-year-long implementation. Those are the main 2 issues they're having. Again, it's education for the security, compliance, and legal folks, and then just internally how to transform that data into a way that can be synthesized. And I guess the last thing I wanted to add to that I forgot to mention was the idea of creating synthetic data for ARM and our clients. It's usually a 2 to 6 week implementation. So we're not talking about a huge capital investment here. It's actually a very quick installation. We've done this for thousands of companies. And as long as you can make the data available, it's not a 1 to 2 year long process. It's actually 1 to 2 months.
Hey, Randy, this is Tim. In the process of converting data structures, data elements into synthetic data, is it typically taking the bulk of the data that the financial institution has, or is it a select cut of the data for a specific use case?
It's a great question. It's the latter. So we advise our clients, we work with very big banking institutions and processors, and if you take them, they might have, if you look at the typical business lines, they might have a credit card division, debit card, loyalty, fraud, ACH, bill pay. What we advocate is you identify we start with 3, right? The 3 biggest opportunities you have to monetize that data. In our experience, it's the credit card, debit cards, and the bill pay. You start synthesizing that data first, and then you simply go down the line, and then you create different synthetic data sets based upon the value of the given data set. And by the way, we do not advocate you create synthetic data for all of your data. It's only for the ones that you have a clear use case on how you're going to monetize it, either internally or externally.
Driven by revenue. I like that.
Yep, driven by revenue, and don't forget driven by that first internal use case I had, which is if your internal employees are looking at raw data and they don't need to be, there's also a very strong use case for having your internal employees look at synthetic data and not the big bowl of raw data.
I stand corrected. Security first, revenue second.
Well, I actually, you can obviously do them both.
So next question here. So when we're talking about synthetic data here, are you creating a fictitious record based upon the actual data?
The answer is yes. So are the slides still available? Do we know? Mm-hmm. Can we go back to the synthetic data slide? Yeah. With the 3 columns? So if you notice, yes. So we actually, it's completely fake. So think of it like this. It's a 1-to-1, in its simplest form, it's a 1-to-1 conversion of one transaction over literally hundreds of millions of transactions. So in the case here, we had a Starbucks or I don't know who it was, call it a coffee transaction. And what we did is we simply changed the fields. We say instead of, let's see here, the real data was $13.56, change it to $14.96. Instead of the date and time being January 19th, it's changed to 2 days earlier and a different timestamp. And again, the reason we do that is so that it can't be reverse engineered back to the consumer and it protects their privacy. I'll give you a further example. Anonymous is actually a very safe way to monetize your data as well. However, the small risk in anonymization happens if you combine the anonymous data set with other data sets, like say location data coming from a cell phone. If a bad actor got a hold of 3 data sets or more, they could potentially be able to get back to the consumer. That's not the case with synthetic data. That's why we advocate getting to synthetic data.
Yeah, I think the real magic of the machine learning tools that you use to create synthetic data is, despite the fact you're altering individual data elements, you're doing it in a way that at an aggregate level maintains the same analysis.
That's right. You're exactly right, Tim. And specifically for those who want to get into the details, I'll spend 1 more minute of it. The good thing about the synthetic data is we actually have a configuration element. So if you want to some banking institutions want more noise than others. And more noise meaning, the ability to move a given transaction more than 1% or 2% up and then 2 or 3% down. So on the aggregate level, someone might want to be 99.8% accurate. Some might want to be just 98% accurate because some institutions want a little more noise in there, but that's entirely configurable The one thing ARM won't allow, and by the way, I would advocate no one should do this, you don't want it to be 100% accurate, because then it's obviously going to be the clean raw data. You want a data that's like 99.9% accurate. Somewhere in that range is what we advocate for.
Awesome.
Excellent. And so another question that I think relates to the slide that you're on here. So does the synthetic data creation alter non-PII data?
The answer is, non-PII data. Yes. So to be clear, synthetic data alters both the PII and the non-PII. So in the PII sense, we obviously, get rid of the name, but we will change the address. We'll get rid of the address, but we'll move it to a census block, right? Or a zip code, right? Depending on what the requirements are. So the PII gets synthesized. But of course, here, as you can see, the non-PII information also gets synthesized, as you can see by the transaction date and transaction amount.
And this goes back to the point you were making, Randy, about being able to take PII, non-PII data, if it hasn't been altered, combine it with second, third level data sets that can bring it back to create the PII data that was lost. And you can't do that if all of that data has been modified.
Yeah, that's exactly right. And that's why, quite frankly, I think it's important to know, if you look at the big picture, the safest way to monetize your synthetic data is a lot of these buyers don't want anything to do with PII. In fact, I can say this, they're as diligent as the banks. I mean, about receiving PII. I mean, it's simply a non-starter for them. They don't want to know it. And in that way, the financial service organizations, payments organizations, are completely aligned with the buyer. They just want big-time aggregated consumer trends.
Good point. And anybody who's read press, have read articles and looked at the news lately knows, yeah, not good to have PII data.
Yeah, Tim, that's another good point. I guess another thing for the audience to think about is, look, the recent breaches with, Equifax and Target and Cap One, those are truly unfortunate. It's gonna happen, for better or for worse. But if instead those organizations would have had synthetic data available to their employees, and if indeed unfortunately a hacker would have got synthetic data, that is unfortunate, but it wouldn't have been near the headlines and not near the reputational risk of a bad actor getting their hands on real PII information, real personal information. So yet another reason why synthetic data is emerging as the safest way to monetize your data.
Excellent. So another question here. So any stats on what type of revenue can be gained by transacting or data set?
Yeah, so the answer is yes. So I'll give you some broad ranges here. And again, I'm not trying to be coy, but you have to understand it depends on the data sets and the size. So I'd say if you have a large amount of data, you can expect somewhere between, a large amount of data is defined by, say you're a top 40, top 30 payments organization or bank or fintech. You can expect somewhere from $10 to $30 million a year in monetizing your data in what I'll call the phase one, those three areas I mentioned earlier. And then keep in mind too that those revenue streams, and we've delivered those, by the way, that's not me making it up. Those are real numbers. If you're smaller, then obviously you have to aggregate. So smaller players, you're probably talking more the $1 to $4 million a year. But it's also important to keep in mind, this is all margin, okay? So it's not, literally it's, I shouldn't say all margin, it's 95% margin. You're just making your data available and then whatever entity, it could be ARM, it could be someone else that does the synthetic data and monetizes it to the market, they're incurring all the costs. So it's a high margin revenue stream at a very low risk.
Certainly worth investigating.
Excellent. So for our next question here, do you create multiple synthetic data sets for a specific purpose?
Yes, because as you can imagine, well, let me back up. Let's say we do internal only, right, for risk mitigation or for machine learning, then yeah. So in that case, the synthetic data, it might have what I'll call a tighter configuration on getting it like 99.999 accurate. But then as we monetize it externally, we might change that dial a bit and create a different synthetic data set that might be 99.8% accurate. That's all a preference of the banking institution. But yeah, you can absolutely create different synthetic data types for the different use case. In our world, we've seen people do that. We don't see a need to go create 10 different synthetic data types. Usually it's maybe 1 to 3 different instances of that synthetic data, and mainly just it's about internal versus external.
Excellent. So now we're talking about organizations getting in trouble here over data. So this next question revolving around Facebook in particular. So why did Mark Zuckerberg get in trouble, and what kind of data type did Facebook use?
I'm going to take the easy answer here, pass that over to Tim.
So it depends on which particular event they're talking about. There was a relationship they had developed with MasterCard that caught a lot of flack. My understanding was that there was no PII data being communicated there, but the assumption was Facebook was using this relationship with MasterCard specifically for ad attribution, when in reality, my understanding is that's not the way the data was being used. So I think it depends on the individual case for where the transactions were discovered to be taking place. And when it's a Facebook, there's an automatic kind of knee-jerk reaction assuming that it's a worst-case scenario. And I think it's worth people taking time to understand exactly what data elements were being shared and what was the purpose of that before one jumps to the conclusion that it was to identify individuals and their shopping behaviors and spin ads at them. It's not always the case.
Yeah, I'll just add on. Yeah, I'll just add on to that. I obviously pass that off to Tim because I like to give him the harder ones. But what we do know, at least on the ARM side, is that it was not synthetic data. I do firmly believe Facebook should be using synthetic data for both internal and external purposes. And while they are not a client, and I don't know much about what they're doing right now, I think I can accurately predict within the next 12 months, if not happening right now, they will be using synthetic data. I think that is going to happen at a high confidence level.
Excellent. Well, thank you, Randy and Tim. I think that's all the questions that we have from the audience at this time. Again, very great webinar. If you do have any additional questions, feel free to reach out to ARM Insights directly at info@arminsights.com. Again, that's info@arminsights.com. If you would like a copy of this webcast or the slides presented in this webcast, feel free to reach out to info@mercatoradvisorygroup.com. Again, that's info@mercatoradvisorygroup.com. This now concludes this portion of the webinar, and thank you very much for everybody attending.
Thank you, Randy. Bye now.
Thanks, Tim. Thank you.